You're well, and welcome to this talk show, and welcome to the month of February. Today, I thought I'll just spend a few moments sharing with you some common price action patterns that you will come across virtually on every chart, on every time frame, every market. So let's have a look at it. The red line is the low of yesterday, and of course, I am using the 5-minute time frame for illustration. But remember, markets are fractal, so whatever you see on one chart will appear on on one time frame will appear on other time frames. Here we had a wedge top and a bear breakout below the low of yesterday after the wedge top. So I'm always looking, when I see a pattern, I want to see what's coming after that. So wedge top, I want to see the bear acceleration. So that's pretty good for the bears. Then got to find a way to get into the market. That pullback, so bear breakout, that pullback, that bear candle was the first attempt by the bears to continue with the selling. So that's a low one, call that a low one in terms of price action terms. And what we want is to get a second entry short. So the market needs to be trying to go short for the second time. It's a higher high, which is good because the bulls were strong enough to try and break out above that first attempt. It's a higher high, but it's failed. So higher high that fails and becomes a second entry short is a pretty good trade to take. Because it's a bull candle, of course, you know, it's a lower probability trade, but it's below the low of yesterday, or LOYD is a low of yesterday, and it's below the wedge top. So that would be a pretty good trade to take. And of course, when you take that trade, you expect an acceleration down all the way to the bottom of the earth, but we don't get that. We go sideways. Now, and I keep saying to guys that there is no noise on the 5-minute time frame. This is information. This tight trading range here is extremely useful because it's showing us that the bulls are trying to break out, but they're failing. Micro double top, so that's double top with one candle beneath it. Also a micro wedge, 1, 2, 3. So very strong forces in play here. Then we get an outside candle by the bulls. An outside candle is a trading range candle, and we wait for a failed breakout, which we get failed breakout above the outside candle with this candle and a reversal. So that becomes a much stronger signal to take than even that one. Okay, failed breakout above the tight trading range, and still we're testing the low of yesterday. So whenever you see these tight trading ranges, and you see double tops, micro wedge top in there, then you see the reversal signal. That is a strong trade to take. If you're taking that trade, stop is still above here, above the wedge top. So do not take both trades, because then it's just increasing your risk. You have to take one of the trades. So that's a pretty strong one to take. It's a breakout, pullback, higher high, low to test of low of yesterday. It's the first one that we got. Then we had the tight trading range at the EMA, and also tight trading range below low of yesterday. Then we have a lower high double top below low of yesterday. So confluence of factors, nested patterns, all confirming bear forces. So second trade to take. If you took that, you just hold on to your trade. No need to exit. And again, you take that, you expect an acceleration, you don't get it, but you get another little tight trading range, and the bears again breaking out beneath that. Then we have bear acceleration. Somewhere within here, the market is going short. So it's always in short. If you haven't taken any of the trades, you got to find ways to get into the market. The only problem is you're going towards the open of the US market. So if you're taking trades, you must keep a wide stop in the market, because you might just get a reversal pattern that kicks you out and the market keeps going your way. What we had at the open, pretty common pattern, not at the open, but often anyway throughout the day, expanding triangle. Okay, market is creating an expanding triangle. You can see the triangle there. An expanding triangle is a breakout mode, usually off the high of the expanding triangle. You expect bears to sell off. Off the low of the expanding triangle, we expect bulls to sell off. So here the market tried to break out above this tight trading range and go to the top of this, now it's an expanding triangle, but if you connect that high and that high, it got to that level. So if you look into trade here, unless you find a lower entry, a better entry off the 1 minute chart, which sometimes I do. You gotta wait for the close of the candle. It comes back to the middle of the trading range, and it's a bull candle. So, bit problematic. Best to wait for a bear candle. You get a bear candle, and the problem with it is that now we were deep into the middle of the first candle. That's the first candle for the US session. Measured move of it is down here, and that's your goal. But bears are selling beneath a bull candle, so low probability trade. You still take it if you want. That's why I put it in gray. It's a low probability trade, but you can take it and manage your trade. Stop up here. You're hoping to get all the way down here, but be aware of the expanding triangle bottom. The bulls could turn the market right there, and you have to get out with a break-even trade. In any case, you were rewarded, and the reward got you to the measured move of the first candle of the New York Stock Exchange Open. That's what I call the US Open. So you'd have to get out there. You know, if you didn't have a profit taken, right there, you must get out above that candle, because bulls are going to be jumping in. And bulls are thinking, well, we had an expanding triangle bottom. We tried to break out beneath it. We failed. Let's take that and see if we're going to test the top of the expanding triangle. It's a low probability trade because you're beneath the moving average. But if this was occurring in another context, you would take that trade. Bulls took it, hoping that to get acceleration up, failed. And as soon as market turned and did an inside candle, if you're a bull taking that trade, low probability trade, you must exit. Scalpers are always in and out of the market. I prefer for these green entries, so I'd rather wait for that. But in any case, if you're taking that low probability trade, fantastic. When you're taking that as an inside candle, your stop is still way up here. That's where your stop would be. You know, you can't stick your stop in the middle of the trading range. So you got to decide that, why am I taking that low probability? We've got measured moves. Am I going to get there? You don't know. So what the market creates here is pretty common as a pattern, a convergent pattern. Just as we had the expanding triangle as a breakout mode pattern on the extremes, a convergent triangle when the price is converging to 1 point is also a breakout mode pattern. We expect that any breakout beneath, above or beneath a convergent triangle will fail, and the market likes to come back to the apex. So here the market went up, failed, came down, bears had a follow through, and they failed breakout beneath the convergent triangle. And you could take that as a first trade, low probability trade. Whenever you see a pattern, wait for the second entry. So here is the second entry, a much better, higher probability trade, micro double bottom, breakout, pullback, distant enough reversal candle. When you're taking trades here, you're trading as a reversal trader. You know, that's what I love trading as a reversal trader. If you don't want to trade that, wait for the market to break out, and you say, oh, okay, now we're breaking out and going up to test that. Breakout, you can take, as the market comes above there, you can take that trade. It's a breakout, it's a pullback, it's a high one, first high after the pullback, so you can take that. Then, of course, you're trying to see if the market is going to get to those levels. We do get there, sideways price action, get a decent enough reversal pattern. Again, low probability trade to take that. Why do you want to take it? Well, it's 10 EMA strongest part of a trend, decent enough reversal candle, but you're going into the low of yesterday. So if you're taking that, drop your risk down to 0.25%. You might just get rewarded and the market goes up, but then also you get this pullback. You don't get stopped out, you know, because when you take that trade, your stop is going to be way down here. That's where the stop is going to be. When the market accelerates up, you can tighten your stop to there and wait. No reason for you to exit. I mean, you took the trade. If you do exit, you can exit before break even, but best to hold on and see what gets. You don't get huge bear candles here. So this is now a high low double bottom, and you get another high low double bottom here. There is a lower low double bottom. That low is lower than that, but it's a high low double bottom. Bad signal for the bulls, and you gotta wait because of where we are. But you're still keeping track of what the market has done. Eventually, get an inside candle just above the low of yesterday, worthy to take that, put your stop down here and see how far you go. Eventually get to a measured move of the breakout above that trading range. Now, just a quick recap. So expanding triangle, the US Open. Expanding triangle is breakout mode. We expect the market to reverse at the top or reverse at the bottom. Converging triangle is also breakout mode. We expect any breakout to fail and the market come back to the apex, which it did. Then we have a major trend reversal alert, MTRA, major trend reversal alert, failed breakout below the converging triangle, and then we had a micro double bottom, which is a lower low major trend reversal alert. It's an alert that this whole bear trend might reverse. Need a little bit more information. Then we get breakout pullback, higher low, reversing reversal signals, a higher low major trend reversal alert. So you can take that trade. I would take that and put my stop and measured move down here. When you get acceleration up, I can touch my stop today. If you don't want to take reversal trades, there is a trade that will take them up here. We're getting higher low double bottoms, and then inside candle is a bull breakout at the low of yesterday. So these patterns do occur sometime during the day in different charts, and I hope you found it useful. Thank you very much, and we will see you Wednesdays live trades and profits, 15-minute show, where we're doing these days quick and punchy. Take care, guys, and we will